Welcome back to Vantage. Small cap actually was a great performing asset class in the first half of 2026. I am delighted to talk to a prominent UK small cap investor, and if you haven't seen his video, it's on the Edison website. Delighted to have Richard Staveley of Rockwood Strategic back with us, and we're going to build on that video from here. So for investors who are less familiar with Rockwood Strategic, maybe you could just briefly introduce yourself, the trust, and what you're trying to do and how you go about doing it.
Sure, and great to be back, Neil. Thanks very much for having me.
Pleasure.
Rockwood Strategic is a main market listed investment trust. We're now nearly 200 million in size. We have a concentrated approach, about 25 holdings, and we're focused on the smallest stocks in the UK stock market. So the majority of our stocks purchased will be under 250 million pounds in terms of valuation. That's much lower than the average UK smaller companies fund. I've been running it since late 2019, and before that I'd actually run UK small companies portfolios for many years, nearly 20 years, and before that I was a chartered accountant. And I run the fund from Harwood Capital, which is a hybrid family office with a range of other strategies like private equity, private credit, property and debt.
Okay, and you started mentioning some of the differentiation between you and some of the others. So there's around 19 AIC UK smaller companies funds out there, and when you look at it, I'd love to understand how you think you're different. What makes you genuinely differentiated in just another fund manager trying to play the smaller companies effect?
Sure. So there are a number of key factors here. Just out of interest, I looked yesterday, and we're now the 8th largest of the 19 funds. And I just mention it because some of people in the first instance what was getting going would have gone, we're a bit too small for them. But now we're right up there with the big boys in terms of size. In terms of differentiation, there are some critical aspects. Firstly, the concentration piece. Yeah. So 25 holdings, but the top 10 are the majority of the capital of the fund. So we're really focused into best ideas rather than a broad spread of investments. The second thing is our value and recovery bias, and that's the style of our investing. So the majority of those 19 funds are kind of quality growth biased, which is what most people instinctively think of in terms of UK smaller companies. But as a style of investing, recovery investing works across the market cap, and we find that in small companies there are lots of opportunities when things aren't going very well, and the shares get very depressed, that there's opportunities for change, typically either operational, strategic or management changes needed to unlock the shareholder value. And that's what interests us rather than sort of finding a sort of multi-year growth company, that sort of thing. So that is definitely different. The third piece, which is very important, is we are active. So we're not activist, although on occasion it does get to the sort of heated levels that people would associate with the headlines some people put out in the newspapers. But we're kind of constructively engaged with the companies that we have. So we take stakes. In fact, of the 25 holdings, 18 of them, we have over 5% of the company's shares, meaning we could call an EGM if they didn't listen to us and we thought we were talking sense and other shareholders would be supportive of the changes we were suggesting. And 13 of the 25 holdings, we've actually proposed board members onto, or even have our own board position. That is real differentiation. There's no other fund in the market like it. Now, there are 4 funds doing more active approaches out of the 19, but the vast majority are all less engaged, broader portfolios, that approach. The final piece, which I think is probably the most critical for any, I would say, well, for many types of investors, is that most of those funds will be benchmarked against one of the indices in UK small cap, typically the Deutsche Numis Index, which is the bottom 10% of the market. Does that couple with the FTSE small, but it's mainly Deutsche Numis. We are focused on absolute returns, making money specifically, not relative returns, and we're paid, and our fees are based off that. That mentality means that we look for every stock that I want to buy for Rockwood, or we're looking to buy for Rockwood, isn't a member of an index that I'm tracking or worrying about the performance. It basically needs to be something that can go up at least 100%. So we have an investment thesis that it literally needs to be based on our recovery expectations for profits, are moving to fair value, there is 100% upside. And the final piece around that is we lean into the investment trust sort of benefits, meaning we've got long-term capital.
Yeah.
And we say 100% sounds like a lot for a share to go up, but not if you say it takes 3 to 5 years.
Yeah.
And so many investors are worried about the shorter term timeframes for them being judged over. And we just say to anyone looking at Rockwood, look, judge us over rolling 5-year periods. That's how we invest. But over those periods, we're trying to look for stocks that can go up by 100%, and we'll let the index or the markets do what they do. That should be enough for everybody.
Yeah, that translates roughly to sort of 15% IRR over 5 years.
That's
right?
correct.
So which is eminently achievable if you. Okay, so you can't have missed it. UK small caps, happy hunting ground for acquirers, take privates, trade bids. It's been in the headlines not just in the last 6 months, but probably the last 2-3 years. What's it telling you about the sort of valuation gap? And does it make you excited about the opportunity? And in particular, what does it mean when you're running concentrated portfolios?
Sure. So there's a number of things there to unpick, I guess. The first is that what you've got is other types of investors, or I would think even more importantly, people in the real world running real businesses saying our stocks are mispriced.
Yeah.
They're saying the valuations are low, that they're good businesses, that there's opportunity to own the future returns from those businesses, and they're prepared to pay a lovely little premium to what the stock market is saying. Now, as you say, it's been quite surprising because this has gone on now for 2 or 3 years. Literally this morning, when this is being recorded, we had a bid for Mighty, which has been around for my entire career. Literally 30 years Mighty's been on the stock market, and we had Rotork last week, Gooch House last week, it goes on. But it seems to that evidence to me, which says externally unbiased people are saying these stocks are super cheap and great opportunities. The kind of asset allocation industry and the wealth management industry isn't reacting by increasing their allocations. So the backdrop has been flows out of UKs and UK small caps for consistently for months on end. So, I mean, literally months on end. I think it's 47 months of money coming out. That, what does that mean? That means that we know it's validated externally, and we know there's the opportunity. For our specific strategy, there's two aspects to it. The fact it's concentrated means if we get that control premium, so if a bid comes in and we get a 30%, which is this average, I think it's actually ticking up in the last couple of years, maybe up to 35%, the average control premium paid to own the whole company, we'll get that into the NAV growth of Rockwood, and that's probably accelerating what we think we'd have got eventually from the stock market. It does gives us liquidity, and as I've mentioned at the start, this is a kind of a liquid strategy. We're taking illiquid stakes to try and create and spot value, but bids coming left, right and centre means there's liquidity from that part of the market, so we don't have to fully rely on the stock market. Now, we are getting liquidity from the stock market, so companies like Galliford Try recently, or one of our best winners of a company called Filtronic, we've sold to other fund managers rather than get a bid, but that's going on. Now, there are some, just to finish off, this feels a bit long-winded, Neil, but I think it's a relevant point, is that a lot of the fund managers that have much more diversified funds, obviously all these bids without any IPOs, it's shrinking the pool, and the universe is contracting. And I can state clearly and honestly at the moment, it's not a problem for Rockwood. It might eventually be, but because we only have 25 holdings, we're looking on average to buy sort of 4 stocks a year. Can we find 4 stocks a year with the 600 stocks under 250 million on AIM? There's another 200 and odd on the main market under AIM. It's not a problem, but so in terms of other strategies, it might be a slightly different picture.
So I'd love to actually understand the process as well. Can you talk us through how you actually go about finding great quality businesses, or potentially great quality businesses, because some of these might need fixing, but at great valuations, and what are the attributes of an ideal investee company for you?
The process is pretty simple. We have the funnel has two parts to it. Firstly, we quantitatively screen using our computer systems for quantitative characteristics that we know have a high preponderance for being the types of investments we want to make. They're relatively simple, there's only a handful of them, but the value in doing it is that the machines are completely unbiased. They force you to look at stocks that you might naturally not feel you want to look at, but they're saying, no, Richard, on these factors that you said are important to you, go and have a proper look. So we do that systematically, and alongside that, because I've been doing this a long time, and also because, let's face it, Harwood also have a very significant network, both of us do. So we have a significant network, and the network, people often, stockbrokers or even regularly company management teams, where they've moved on, or indeed actual other fund managers will come to us and say, we know this is the sort of thing you're looking for, and that's a sort of organic, kind of unstructured way. But that's also, we have to be truthful. That also happens too. Once what we're looking for then, once our initial due diligence will involve, it's mainly fundamental. We are integrating AI into definitely the sourcing of fundamental information. I can't tell you exactly what mechanisms we're using because it's competitive advantage, we think, at the moment, but that's speeded up our process of kind of filtering out the next stage. But we will, after our due diligence, we then I have a investment advisory group. So it's not a committee. It's a group of individuals who collectively add up to 200 years of investing experience. They're all fund managers. They've all done it in the UK, and they're great guys. They've got their own networks. They've got and they've got their own experiences for various stocks, and they see the research that I write. At that point, it's full of usual typos, unfilled out paragraphs, but the main bones are there. And then they will say, oh, that's a bit, that risk you put as the fifth risk, Richard, that's the most important risk. You should really prioritise that. Or one of them might go, oh, I know Jeff. He's on the board there. I'll make an introduction to Jeff. He'll be a sympathetic ear to change if we're trying to change things, or indeed, it might be, I know that finance director, he's blimmin' useless. That'll be the source of the problems, Richard. So we'll do that. I'll then take that advice on board because I trust them and I think that they're great guys, and then integrate it into the research, and then decide later on whether to go for the investment or not. We typically buy 2 to 4% in the first instance, and then we're trying to move it up to 5 to 10% plus, and then we'll run our winners. That's the kind of process. One thing I just point out, because we've got less stocks, we've got a lot more time for monitoring. So the engagement piece and the monitoring piece are much more intensive than a lot of fund managers tend to do after they've bought a stock. Often they only meet the companies once a year or maybe twice. What are we looking for? What we're looking for is depressed share price, depressed profitability / returns, so return on equity or return on capital low margins, and depressed valuation. Those are the key three characteristics which are the source of alpha. And then we're mean revisionists. So what we want to do is we want to look at, did this company used to make decent returns? Not necessarily the highest quality ones that certain fund managers would say we only buy brilliant companies like this, but good returns and fine returns, but used to be at this level of returns. And then they're now making low-level returns, and then we want to think, right, we then need to due diligence, is there an opportunity to mean revert those profitability or returns back to where they were? Normally, when your returns have gone through a period of decline like that, the market kind of gives up on you. They don't believe in the future. They extrapolate what's been happening, and they also put a low valuation on. So our valuation work will be on what did it used to be valued on when it was performing fine? What are its peers? What are the peers that are doing a good job valued on? What are the transactions happening? And we look at that, those sorts of factors. Often then we find, as I mentioned at the start, we see that change is needed to get to turn the ship round. It might be the disposal of division, pivoting of strategy. It might need new management or a sharper board, more focused on shareholder value. And in relation to that, we'll engage with all the stakeholders about that change that's needed. We'll run it through. We establish, what the target recovered returns will be, what the target recovery valuation will be, due diligence that, and then buy for the 3 to 5 year.
Okay, give us an example of an engagement where you think it's led to a material better outcome for shareholders as a result of your recommendations or suggestions.
Sure. I think there's a great example we can talk about in a moment. But before I do that, what I would say, and it sounds odd, it feels like I've been doing this an age, but I've been running the fund for like six years.
Yeah.
There are a number of things that we've done in quite a few of the holdings in the last 2 to 3 years where it's definitely too early to see what we expect those changes to have done. Yeah. So hopefully when we come back again in a year or two's time, we'll go this and that. But just to be honest, in terms of the maturity of the profile, we've done quite a lot at a range of companies where the fruits of those changes, it's unrealistic to have expected them to manifest themselves yet. But a great example of one where it has would be Funding Circle. Yeah. So Funding Circle, 2.5 years ago when we first purchased it might actually be three now. It had listed at 1.5 billion by Goldman Sachs, led the IPO of that, and 3 years ago it was valued at 125 million pounds market cap. Yeah. Even though the most recent results we looked at when we started looking at it stated they had 250 million of cash. Yeah. So quite a lot of cash. Now, obviously, the market was saying, implying that they were going to burn through all the cash. Although this is where, at this part of the market, down in the weeds of 100, 200 million market cap, it wasn't really implying it. It was just the momentum had just carried on, and they weren't really doing the work at all because actually, Funding Circle was getting much closer to profitability than it had been at the IPO. Now, they were sitting on all this cash and they were saying quite openly, we don't need it all. It's sort of excess. We've got more cash than we need for our business plans. So I thought, well, surely buying back shares would be just a natural thing. So I went to speak to the board, to the advisors, and importantly to other shareholders, institutional shareholders, household names, who and they said, we've said they should do that, but they don't think it's, we don't think it's right. So I said, well, let's just do this with a bit more earnest. We'll lead the charge. So we led the charge, and we said, look, you need to start buying back your shares. Secondly, the world's changed. Sort of running loss-making businesses, which was fine when interest rates were zero when you listed, isn't fine anymore. So we need to accelerate the move to profitability. And I haven't really seen a proper cost-cutting approach from you guys. I think you need to step up and do a bit of that. Plus, I think that at that point, I may be called out on this for the nerds, but I think there were literally 10. It was something like 10 board members. Yeah. We were 125 million market cap. They were still sort of thinking here, and actually we were here. And guess what? It didn't need to get. It was all constructive. The penny dropped, and subsequent as we'd bought. By then we'd bought 3.5% of the company. They initiated their initial buyback. They've since done 2 more. They're still in the process of doing one. They then went on to the finance director, did change. The board's been sharpened up, evolved, and got smaller. They announced a cost-cutting program to take £15 million out of the cost base, and as a result, got into profits a year early than they expected, which was taken well by the market. And all shareholders, including all those stakeholders we spoke to before, have now benefited. I think the shares are now up. I think it's been a 5-bagger now, relative to where we first bought. And this is where we're running our winner. We think Funding Circle, by the way, for those that are thinking, we've missed it or should have bought 3 years ago, it's fine. We think Funding Circle is going to be £1 billion company again. So lots of upside still. Yeah,
great. And there is this concern that there is, smaller companies, there's a liquidity trap there, right? So because outside of bid interest coming in, you just might stay there for a very long time. You've articulated some of the ways that you can affect that change. You know, go in, talk to the companies, start doing things which are constructive. It would be nice if we got some external help to put the wind back in the sails. And we have been talking about reform in the market. Now, I don't want this to be any kind of political statement, but let's focus it in terms of, in the ideal world, what are the changes that we might hope to see from a policy level, a government level, that you think might make a difference to not just the smaller companies market, but the UK market as a whole?
Sure. In terms of intro to that, I think it's important to compartmentalise the issue in the way I think about this. The first is, the reason why small caps haven't been performing overall is because of the flows.
Yeah.
So the flows have to change, all the other stuff, but if the other stuff doesn't happen and the flows stay as they are, it's still not going to work. Okay, so it has to translate into moving positive flows rather than positive out. And I think it's worth saying that in 2026, as we do this now, the House of Commons pension fund has 1.2% in UK equities. The average pension fund, we understand, is at 3.5% UK equities. The MSCI weight is 4. So the process of pension funds and large pools of capital selling all the euro equities is over. That's behind us. So all we need now is people to start buying, to stop selling. Now, there is a bit more still to come out of wealth managers if they just lazily copy what happened in the pension fund industry. But actually, we're already, even with wealth managers, below the levels that other countries have in terms of exposure to their domestic stock market. So there's no reason why they have to go all the way like the pension funds have. The second thing is interest rates, and interest rates, I think, are the primary driver, not government, to getting the small cap outperforming large and getting flows. And interest rates were starting to fall before Iran. And indeed, all the data would suggest, I think most people can see, that the economy is sort of spluttering a bit, and probably 3.75 feels still a bit too high for this economy, and they could be cutting a bit more. So those should come, and that will be quite positive. But to turn the situation around on a sustainable basis, you're absolutely right. I think we do need some help from government. So there are 3 aspects to it. The first is British ISAs, afforded by the taxpayer. We allow people not to pay tax that they should pay, which they pay on corporate on capital gains tax, by having things sheltered in their ISA. Afforded by us, you could just go. You've got to invest in UK listed stocks and UK listed funds, which obviously would be like Rockwood, but I don't mind. It would just be, that would be key. People could decide what they want. That would be number one. I think the second piece is about the large pools of capital, which are sort of one step away from government. And I think Labour actually get this. So they've talked quite a lot about local government schemes, quasi-public schemes. And I find it, I find it's very difficult to argue against that local authorities shouldn't invest the money in the UK economy, in UK shares. Interestingly, for those that are watching Rockwood very closely, a very significant local authority pension fund has just become a over 3% shareholder of Rockwood. So we think some of the more enlightened local authorities are getting ahead of maybe the sort of stick maybe that might be coming, and saying, well, actually, we can see the opportunity here. Let's invest more in the UK. Now, the one I'm going to be the most controversial about, I'm afraid, is stamp duty, which there are a big portion of the market think is absolutely critical to rehabilitating the market. But for an investor who buys and then holds for 5 years and then sells, it's not really a big deal. For me, I can see why elements, but and overall liquidity would help the market, so I can see why it would be a positive thing. But it's not something that I'm particularly fussed about. I think from the government overall, and I think probably everyone in the country, whether you're interested in markets or not, knows this is what we want. We just want a bit of continuity and a bit of stability.
Yeah.
And, please, can we just have that? And that would probably be all you need domestically for people to start thinking, well, actually, UK small caps, now there's a bit more stability, a bit more continuity, interest rates falling, the nudge is there. Let's look at those UK allocations and maybe start to question those huge allocations to very expensive US technology stocks.
Yeah, extraordinary, that you can buy SpaceX. The risk appetite is there. If you can buy SpaceX and for the UK, certainly there is something there. And I asked the question because one of the things that stood out on the Rockwood video that I mentioned at the beginning is, you invest in British companies, you want Britain to do well. You're a British fund manager, and it really sort of came through that there's a drive there. Okay.
Well, I'll just add one point on this, Neil, that just to put in, for those that really want the stark contrast of the true opportunities from a valuation perspective. So some people say, well, valuation doesn't matter. Good for them, that's not how it, but for those that think it might matter or think that there might be a point where it matters more, there are now, I think it's 20% of the S&P are on 10 times sales.
Yeah.
Rockwood's portfolio is on less than 1 time sales.
Yeah.
1 time sales.
Yeah.
It's just a huge gap now between America and UK small cap.
Yeah. But great. So look, I mean, if you had some key messages for viewers of this to take away, what would they be? If you wanted people to know about Rockwood, what would be the 2 or 3 things that you want them to sort of remember?
We're differentiated.
Yeah.
And we're not making that up because you can see that our performance profile, for those that have looked at it, is differentiated over the last few years. I think, secondly, that the market is depressed and on its knees, and we've delivered those returns despite it being difficult. We could be in for an interesting ride if things become a bit easier. And I think, thirdly, we are a stock picking fund that care deeply and passionately about British stocks and British investments and stock picking and turnarounds, recovery situations. I think those are the 3 key things.
Richard, as always, huge pleasure to have you on the show. Thank you very much.
Thank you very much, Neil.